The Federal Reserve just said that they plan to raise interest rates in 2022. What's going on, everyone? This is Lucas Miller with Fear Free Passive Investing, both the podcast and the YouTube channel. Welcome to another episode. So the Fed just concluded their December Q4 meeting in 2021, discussing issues that are going to come up in 2022. A lot of this is preliminary. A lot of this just came out yesterday, but I wanted to quickly get on and talk about the top takeaways, I guess, from this meeting. And it's going to be interesting because this is really the first time that we've talked about interest rates rising over the past 18 to 24 months, really. And we've actually heard a serious, I don't know how to put this, a serious emphasis on raising rates and inflation and how it's kind of getting away from us. So we're going to talk about that. We're going to talk about what that means for commercial real estate. But first, welcome to the channel if you're brand new here. We appreciate this. We do mostly videos on passive investing. We do podcasts on interviews with passive investors. We talk about tips to help you be a better passive investor. And we do news reactions just like this one. So welcome. Consider subscribing. We do a lot of fun videos like this too. Okay, so back to this meeting. So the Fed just concluded this meeting yesterday. Jerome Powell did a press conference after the fact, and there's some top takeaways. So they concluded the December meeting yesterday, and one of the top line things that you're going to see a bunch in the news is that they are going to get aggressive with their asset purchasing taper. This is quantitative easing, right? This is the bond purchasing. They are going to aggressively taper it. Going into this meeting, nobody thought they were actually going to raise rates. Nobody thought they were going to raise interest rates. But we did hear rumblings of them tapering their balancing purchase or their asset purchasing taper. And we didn't really know what to expect with that. And so it's interesting because it came out and it was a little more aggressive than a lot of people thought it would be. So that's interesting of note. That kind of is a red flag to me. And we'll talk about that in a minute. But they also indicated that they will see as many as 3 rate hikes in 2022. This is interesting. So, they always say there is the potential for interest rate hikes, but this is the first time in like I said, 18, 24 months-ish that we actually kind of believe them. The Fed Chairman Jerome Powell said that the cyber attacks are some of the most significant risks to the financial system right now. He said that the Omicron variant of coronavirus, it is a risk. However, it will not impact their accelerated taper. This is really interesting because the quantitative easing was essentially put into place because of coronavirus. I mean, not put into place in the last decade or so, but really ramped up over the last 24 months. The stimulus bills, the continuing resolutions, the stimulus checks, all that is a type of quantitative easing. And essentially, this is saying like the whole thing that caused it in the first place is not going to be a factor in us tapering that off. So that is interesting. He did also say that inflation is here to stay, at least for the meantime. They're not actually using the term transitory anymore, excuse me. So that's definitely a huge signal that inflation is worse than most people were thinking it was. But it's also a signal that it's not actually going to go anywhere. So let's put this into context, the Fed event. Let's put it into context of where we're at with the economic cycle. The Bank of England actually just rose their interest rates, which was really interesting. That was actually kind of unexpected. It was a shock to a lot of folks. And so it shows that there's a little bit of a panic. Personally, this is my interpretation of this. It shows that there's a panic with inflation, where they're at with it. So that was really interesting that they raised rates. That was a little bit unexpected. So perhaps a little bit of panic. Who knows really why they did it necessarily, but the quantitative easing definitely didn't help this scenario. Inflation's out of control, and I think they're starting to really realize that. So that was kind of interesting. The the thought in the economic circles is that the Fed is probably going to follow that model. I think by the end of 2022, they're projecting around a 2.6 percent, opposed to hovering right now between 5 and 6% inflation. So their economic outlook is positive. They do think that things are going to get better. But to me, that this kind of signals that there's much bigger problems and much more serious problems than what they're projecting. So sure, they see that things are going to get better, but there's plans to taper QE despite the Omicron, which everything in the news about Omicron is that it's much milder, sure, but it's another variant that has enveloped the news cycle. You haven't heard about it lately because there's not a lot of deaths that I've seen anyway. Not a lot of data proving that there's a lot of deaths. Not quite as transmissible as the Delta variant. So, but usually I would have expected them to leave that door open. So it shows me that they see this as a serious problem. So let's put this into context. What does it mean for commercial real estate right now? Well, interest rates are likely to increase next year. Probably in March 2022. I don't think they'll be quite ready to do that in January. That seems way too soon. So how much, we're not really sure right now. How much rates are going to increase next year, not really sure. But this makes sense because in the meeting yesterday, Chairman Powell actually said that the interest rates, or excuse me, that the asset prices are actually slightly elevated, is what he said. He wasn't necessarily talking about commercial real estate. He was more talking about corporations, corporate debt, things like that are slightly elevated. So it's not necessarily commercial real estate, although I think it's probably applicable. So what does that mean for specifically multifamily, let's just say, and commercial real estate? But typically in an interest rate increase environment, you'll see asset prices go down. The debt is more expensive to obtain. Therefore, the amount of money that they have to pay for a building is going to go down. It makes sense, and it's typically followed the same path. However, we are not in a typical time. We haven't been for quite some time, arguably more than the 2 years we've been in the coronavirus situation. So I would be interested to see how this is actually going to play out, if things are actually going to see asset prices go down. Another thing, it could be more exposure for variable interest rate loans. We'll see with that. If rate increases go up, some of those loans might, some not. So could be more exposure for them. So my prediction based on this meeting with regard to the Fed and interest rates, this will have no immediate impact on commercial real estate prices. I don't see that happening. I think it's going to be atypical of what I just described. Rates will slightly increase in March of 2022, I'm guessing. Cap rates will continue to compress. It's just how I view things. Foreign investment flocking to any sort of yield, any investor going toward there are so many investors searching for anything with a positive yield right now. The barrier is very low. Then you add on top 1031 exchanges, people trying to squeeze those in. They're not going to be price conscious necessarily. So I just don't see cap rates going anywhere but either stagnant or compressing slightly. So conclusion, my conclusion for this is, don't be afraid of the economic news. It's interesting to follow, but I don't necessarily know if that will play into every strategy. I think there's strategies that will make people money no matter what situation it is. The Fed is not your friend. If they have this much power over economic news, it's not a healthy relationship. Let's just say that. Maybe we'll do another show on the Fed sometime soon. But all that to say, the Fed is not your friend. Inflation is just going to eat your cash right now. So if you're holding on to a lot of cash, it's getting eaten up. You got to throw that into an investment. You can always make more cash, but you really need to buy something tangible something like commercial real estate, although that sounds like a plug, but it's not necessarily. If your goal is passivity, this is the time to jump into a deal. This is a good time. It's tangible, something that's passive if that's your goal. If your goal is active investing, that's a little different. I would definitely still jump into a deal for sure. But making sure you're well capitalized right now. That goes for either active or passive investing. If you're passive and you're analyzing deals, you've got to make sure that they have a very low break-even occupancy, very low break-even rents, a very healthy contingency budget. You want to make sure they're able to weather storms, because I'm guessing there is slight storms coming for commercial real estate. I think they will see much higher valuations and compressed cap rates on the other side. I don't think you're ever going to see an 8 cap in Dallas anymore, or Denver, places like that. But there is real, you have to pay the bills. Like, there is no way around that. You don't want to go bankrupt. So making sure you're well capitalized is critical. So those are really my takeaways. That's all I have for this video. I know it's not the most exciting, most entertaining videos to talk about, but I think it is interesting and it is applicable to commercial real estate investing, and we're all about mitigating fear here. So, if you have any questions about this, make sure to reach out. But as always, we'll continue to follow the news and tell you how it relates to commercial real estate. Make sure you check out other videos if you're interested in that. If you're not, we wish you the best of luck. Thank you.